Preparing for Kellogg's FP&A Analyst interview, you've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through your background and why you want an FP and a role at Kellogg's. My background combines financial analysis, accounting, and business partnering. In previous work, I built budgets, investigated variances, and translated operational data into recommendations. I am drawn to Kellogg's because its branded food portfolio requires disciplined forecasting while adapting to changing input costs, retailer demand, and consumer preferences. In this role, I would bring strong Excel skills, curiosity, and a practical communication style to help leaders make better decisions. While answering, connect your accounting, finance, analytical, and communication experience to planning, forecasting, variance analysis, and business partnering in a consumer packaged goods environment. Question 2. Why do you want to work for Kellogg's? Kellogg's interests me because it combines iconic brands with a complex, fast-moving consumer business. Finance decisions affect pricing, promotions, manufacturing, distribution, and customer relationships, so the analyst can see how analysis changes real outcomes. I also value the company's emphasis on integrity, inclusion, and long-term brand strength. FP&A would let me contribute through rigorous forecasting while learning how a global food company balances growth, margins, and changing consumer needs. Make sure to cover Kellogg's recognizable brands, consumer-focused operating environment, scale, innovation, and the opportunity to connect financial analysis with pricing, volume, cost, and commercial decisions. Question 3. What is the difference between a budget, a forecast, and a long-range plan? A budget is the approved financial target for a defined period, usually establishing accountability for revenue, costs, and investment. A forecast is an updated estimate of expected results using current information, so it can change throughout the year. A long-range plan looks several years ahead and connects financial expectations with strategy, capacity, brands, and markets. In practice, I would compare actuals with the budget, refresh the forecast, and use the long-range plan for strategic context. In your answer, distinguish purpose, timing, ownership, and flexibility, explaining how the annual budget sets expectations, forecasts update outlooks, and long-range plans support strategic decisions. Question 4. How would you perform a monthly variance analysis? I would first validate the actuals, budget, prior period, and reporting hierarchy. Then I would identify material variances and break them into drivers such as volume, price, mix, timing, foreign exchange, or spending. I would discuss unusual movements with the responsible business partners, test whether explanations reconcile to the data, and summarize the implications clearly. Finally, I would distinguish one-time items from recurring trends and reflect genuine changes in the latest forecast. Be sure to mention data validation, budget and prior period comparisons, materiality, root cause analysis, operational drivers, management communication, and follow-up actions rather than simply reporting favorable or unfavorable movements. Question 5. How do the three financial statements connect, and why does that matter in FP&A? The income statement shows profitability, while the balance sheet shows resources and obligations. The cash flow statement explains how operations, investing, and financing change cash. Net income flows into retained earnings, working capital movements affect operating cash, and capital spending affects both cash and fixed assets. This matters because an apparently profitable plan can still consume cash. In FP&A, I would assess earnings, liquidity, and balance sheet capacity together before recommending actions. Focus on the income statement, balance sheet, and cash flow statement linkage, including net income, working capital, capital spending, debt, and how operating assumptions flow through an integrated forecast. Question 6. How would you build a sales forecast for a packaged food business? I would begin with a driver-based model by brand, product, channel, or customer. Revenue would typically reflect volume multiplied by realized price, with adjustments for mix, promotions, distribution, seasonality, and new product launches. I would combine historical trends with sales and marketing input, challenge assumptions against market information, and create base, upside, and downside cases. I would then reconcile the forecast to production, inventory, margin, and cash requirements. Mention volume, price, mix, promotions, distribution, seasonality, customer or channel assumptions, historical trends, commercial input, and scenario analysis to distinguish revenue growth from underlying demand. Question 7. Raw material costs are rising sharply. How would you assess the financial impact? I would quantify exposure by commodity, product, plant, and purchase timing, then compare contracted costs with current assumptions. Next, I would model the gross margin effect under different inflation scenarios and include hedging coverage, productivity savings, pack changes, pricing, and potential volume elasticity. I would partner with procurement and commercial teams to evaluate mitigation options. The final recommendation should show the net financial impact, timing, risks, and what assumptions require monitoring. In your answer, cover exposure by commodity and product, timing and hedging, pricing actions, productivity, mix, volume elasticity, gross margin impact, scenarios, and communication of risks and mitigations. Question 8. What working capital drivers would you monitor in FP&A? I would monitor receivable days, inventory days, payable days, cash conversion, and movements against plan. For a food company, inventory deserves particular attention because demand changes, shelf life, promotions, and service levels can create write-offs or excess stock. I would investigate changes by customer, product, and location, then connect them to sales and supply chain plans. The objective is not simply minimizing inventory, it is balancing availability, freshness, working capital, and customer service. Make sure to discuss receivables, inventory, payables, days metrics, customer terms, production planning, slow-moving stock, seasonality, cash conversion, and trade-offs between service levels and liquidity. Question 9. Describe an Excel or financial model you have built. I built a monthly expense forecast that consolidated actuals, headcount assumptions, vendor commitments, and department budgets. I structured the workbook with separate input, calculation, and output tabs, used controlled formulas and validation checks, and added variance flags for material changes. The model reduced manual reconciliation and gave managers a clearer view of remaining spending capacity. I also documented assumptions so another analyst could update it without relying on my personal knowledge. Be sure to explain the business purpose, data sources, model structure, key assumptions, checks, outputs, stakeholder use, and how you improved accuracy, transparency, or efficiency. Question 10. Tell me about a time you influenced a business partner who disagreed with your analysis. A business partner once believed a cost overrun was entirely timing related. I first listened to the operational explanation, then separated invoice timing from a recurring run rate increase using transaction-level data. I presented both views, highlighted the common facts, and proposed tracking the expense for another month with a revised forecast. The follow-up confirmed a structural vendor rate increase, allowing the team to renegotiate terms and improve the forecast without damaging the relationship. Use a concise STAR structure, emphasizing listening, fact-based challenge, shared objectives, clear assumptions, collaboration, and the measurable result rather than presenting disagreement as a personal conflict. Question 11. Which KPIs would you use to evaluate a branded food business? I would start with net sales, volume, price, mix, gross margin, and contribution after trade spending. I would also monitor market share, distribution, promotional effectiveness, fill rates, inventory, working capital, and operating cash flow. The right dashboard depends on the decision. A brand review may emphasize household penetration and share, while a supply chain review may focus on capacity, service, and waste. Strong FP&A connects operational indicators to financial outcomes rather than reviewing revenue alone. In your answer, include net sales, volume, price and mix, gross margin, trade promotion, market share, distribution, service levels, inventory, cash flow, and brand or innovation indicators. Question 12. How would you handle inconsistent or incomplete data during a forecast cycle? I would first identify whether the issue came from definitions, timing, missing records, or a system error. I would reconcile the data to the general ledger or another independent source, speak with the owner, and document any assumptions used. If the gap were material, I would escalate it early and present a range rather than false precision. After the cycle, I would help establish clearer ownership, validation checks, and a repeatable data quality process. Focus on identifying the source issue, validating against independent data, documenting assumptions, quantifying uncertainty, escalating material gaps, and improving the process so the same problem does not recur. Question 13. A product is growing sales but losing money. What would you recommend? I would first determine whether the loss is truly incremental by reviewing price realization, volume, mix, trade spending, variable manufacturing costs, logistics, and avoidable overhead. I would separate temporary launch costs from recurring economics and assess strategic benefits such as retailer access or brand growth. Then I would model options including price changes, pack redesign, sourcing improvements, promotional discipline, or discontinuation. My recommendation would prioritize contribution and cash impact, supported by realistic customer and volume assumptions. Mention unit economics, price realization, product and customer mix, manufacturing costs, trade spend, overhead allocation, strategic value scenarios, and whether the recommendation is to fix, reposition, scale, or exit. Question 14. How do you prioritize when several stakeholders need analysis by the same deadline? I rank requests by decision impact, deadline rigidity, dependencies, and effort required. I clarify the minimum useful output for each stakeholder, communicate trade-offs early, and protect time for high-risk deliverables such as the forecast or close reporting. Where appropriate, I provide a clearly labeled preliminary view before completing deeper analysis. I also reuse reliable templates and automate repetitive steps. This approach keeps priorities visible without sacrificing accuracy or creating surprises. Be sure to discuss business impact, urgency, dependencies, effort, transparent communication, scope control, escalation, and maintaining quality through standardized templates or clearly labeled preliminary outputs. Question 15. What would you focus on during your first 90 days as a Kellogg's FP&A Analyst? During my first 90 days, I would learn the business model, brands, reporting hierarchy, planning calendar, and key drivers behind sales and costs. I would meet finance and cross-functional partners to understand how decisions are made and where reporting creates friction. I would validate existing models and definitions before suggesting changes, then pursue a practical quick win such as improving variance commentary or automating a reconciliation. My goal would be dependable execution and trusted relationships. Cover learning the business and planning calendar, understanding reporting definitions, building relationships, validating models, identifying quick wins, and earning credibility through accurate, timely, decision-useful analysis. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.